Together with me, Nur Najat, Fazidatu Ardiana and Noliana Husna. We are from Group 8B. Assalamualaikum. Hi, my name is Nuradra binti Hamid. Together with me, Nur Najat, Fazidatu Ardiana and Noliana Husna. We are from Group 8B. Today we're going to present on the topic of Takaful Act 1994 and Islamic Financial Service Act 2013. So first is introduction. Insurance and Takaful act as the shield institution and hold economies against threats of any entities lacking in terms of financial arrangement or financial ability to address. The Islamic Banking Act, which is also known as IBA 1983, was Malaysia's first regulatory act required full-fledged Islamic banks to be licensed and regulated in order to create a Sharia advisory board to supervise the bank's operation. Takaful Act 1994 is an act to regulate takaful companies in Malaysia and for other purposes related to or applicable to takaful. In ensuring Sharia governance is permissible, Malaysia took an innovative strategy incorporate Sharia governance into the country's national legal structure regulating the Islamic banking and finance operation.
Next, in regards of the abolishment of Takaful Act 1948, the lawmakers believe that it is time to update the terms and conditions according to the modern world. This new act will be more better as it combines the Islamic financial and takaful services under the same act. Moreover, it will be more convenient for everyone as the new act provides regulation that the Takaful Act did not have to offer, such as the regulation of Islamic financial institutions, payment systems, and more. Besides, it did not provide anything in regards to the oversight of the Islamic money market and Islamic foreign exchange market to promote the financial stability and compliance with Sharia. All in all, the abolishment was mainly for the consumer.
Next is the establishment of Islamic Financial Service Act (IFSA) 2013. Some of the objectives of IFSA 2013, other than filling in the loopholes in Takaful Act 1988, are to increase the confidence of the customer towards Takaful by promoting financial stability along with being Sharia compliant. The first importance of IFSA is Sharia governance. To achieve and to be acknowledged as Sharia compliance Takaful, IFSA 2013 explains in detail regarding the duties of the management of Takaful operators, the board of directors, and the Sharia committee. The duties are according to the guidelines for Islamic Financial Institution (IFI) issued by Bank Negara Malaysia in the year 2011. The Sharia Governance Framework (SGF) also plays a vital role in Islamic Takaful in general, as the objective of it is to strengthen the role of BOD, the SC, and the management of IFS, especially on Sharia matters. This can be seen in the Section 29 of IFSA 2013, where it stated that the bank may specify standards on Sharia for any kind of matters that need to be referred to and according to Islamic law by the SAC. This section also mentions that every member, including the director of the Sharia committee, must comply with the description of duties, procedures, and policies that have been adopted to ensure that such institution can achieve the Sharia compliance status. Other than that, according to Section 29 Clause 6, any guilty person who fails to comply with any standards specified under subsection 1 commits an offence and shall, on conviction, be liable for imprisonment for a term not exceeding 8 years or to a fine not exceeding 25 million ringgit or to both. Next is permissible takaful interest. As we all know, the general rule in Islamic banking is that any form of interest is prohibited under the Islamic law on the ground of riba. However, according to SAC of BNM, the concept of insurable interest is applicable in takaful as it is still Sharia compliance. The requirement of permissible takaful interest is laid down in paragraph 3, Schedule 8 of IFSA 2013, whereby in the paragraph, it provides that paragraph 3 is applicable to a family takaful certificate issued in respect of a contract of family takaful entered into by a takaful participant on a person covered other than the takaful participant himself. If a takaful participant entering into such a contract of family takaful does not have a permissible takaful interest in the person covered at the time such contract is entered to, the contract shall be void. Meanwhile, in paragraph 3, clause 6 in the same schedule of the same act explains that a person shall be deemed to have permissible takaful interest in the person covered if that person is A. his spouse or child, B. his ward if he entered into the contract of takaful with still being a minor, C. his employee, and D. a person on whom he is wholly or partly dependent for maintenance or education at the time he entered into the contract of takaful. However, it is important to keep in mind that such permissible interest is only applicable in family takaful business, as the Act is still silent on the application of permissible takaful interest in general takaful business. And lastly, is payment of takaful benefits. Unlike Takaful Act 1988, IFSA 2013 introduced the guidelines on the payment of takaful benefits. This can be referred to Section 142 of IFSA, where it stated that Schedule 10 sets out provisions for the payment of takaful benefits upon death of a takaful participant under a family takaful certificate and a personal accident takaful certificate issued in respect of the contract of takaful entered by the takaful participant upon his life. Other than that, the Schedule 10 of IFSA also stated that the takaful operators are required to expose or display the minors in the nomination form. According to the paragraph 4 of Schedule 10 of IFSA 2013, the takaful participant may assign the takaful benefits to a person or designate the nominee to receive such benefits as beneficiary under conditional hibah, or, according to Clause B, the takaful participant may designate the nominee to receive the takaful benefits as an executor. Even though the IFSA had laid down the manners of how the takaful benefits may be paid, if a participant wishes to have another preference, it is allowed to do so, as it is not mandatory for a participant to choose one of the two options, as Schedule 10 of IFSA 2013 also provides for payment of takaful benefits where there is no nomination under the paragraph 5.
Today I will be explaining about the difference between Takaful Act and the IFSA 2013. IFSA 2013 is actually a recommendation of Islamic Financial and Takaful Service. There are actually not much of a difference in both acts, but there are certain differences that will actually prove that IFSA 2013 is the enhanced law compared to the Takaful. Of all, we can see in the definition of takaful itself. According to Section 2 of Takaful Act 1984, it has defined takaful as a scheme based on brotherhood, solidarity, and mutual assistance which provide for mutual financial aid and assistance to the participants in case of need, whereby the participants mutually agree to contribute for that purpose. Meanwhile, in Section 3 of IFSA 2013, it has defined takaful as an arrangement based on mutual assistance under which takaful participants agree to contribute to a common fund providing for mutual financial benefits payable to the takaful participants or the beneficiaries on the occurrence of pre-agreed events. Moving on to the Participants' Risk Fund. According to Section 2 of Takaful Act 1984, it is silent on the existence of the fund, of which the purpose is to maintain all contribution donated by the participants. Meanwhile, in IFSA 2013, in Section 90 of the IFSA 2013, it has included every definition of fund, such as Participant Risk Fund or Tabarruk Fund. Moving on to the term of case need. In Takaful Act 1984, the payment of mutual financial aid to the participant in case of the need are not being specifically described yet. But in IFSA 2013, it has strictly defined the case of need, which explain the pre-agreed events as mutually agreed in the Takaful certificate. And in beneficiaries, the Takaful Act 1984 has limited that the benefits from the Takaful to the participant only, which is contradictory in IFSA 2013 that allows the Takaful participant to choose its own beneficiaries on the pre-agreed events. It explained that in the Takaful Act, if a participant die, the benefits will go to the beneficiaries directly, but in IFSA 2013, the power is on the participants to determine who would actually receive the Takaful fund. Moving on to the implementation of Sharia law, IFSA 2013, the implementation of Sharia requirement in IFSA 2013 is much more stricter compared to the Takaful Act previously. As the foundation of Takaful is the Sharia-based insurance, their focus is stricter on that side of the law. It has the BNM and the CSC power over certain cases. Moving on to the minimum capital requirement, it needed to set up a business that involves Takaful, but IFSA 2013 has taken a drastic change to abolish such requirements and legislate that any requirement needed will be laid down by the regulators in accordance to Section 12.1 of the IFSA 2013. In Takaful Act 1984, it has allowed business operator to carry business under the same company. Meanwhile, in IFSA 2013, it requires a takaful operator with a different license for family takaful business and the general takaful business. The takaful operators who followed Takaful Act 1984 were given the term of 5 years to follow the requirement laid down in Section 16(1) of the IFSA 2013. Regarding the proper claimant, a proper claimant is said to be a person who claims that he or she is entitled for the benefits as he is the executor over the deceased asset, or a person who claims his entitlement over the asset based on certain laws. In Section 65(1) of the Takaful Act mentioned that such payment of the takaful benefits may be made to a proper claimant. Meanwhile, in IFSA 2013, it has a different approach of proper claimant, which is part of the duty of the executor to distribute the asset or the takaful benefits based upon the inheritance law applicable to the takaful participants. Assessing this situation, the new definition of proper claimant has been made, which includes parental guardian of an incompetent nominee or an assignee, or who claims to be otherwise entitled to the takaful benefits under such law. That's all.
Next, in terms of the application into the takaful, so officially replaced the Takaful Act 1948 at 30 June 2013, and it has changed the overview and landscape of the insurance industry, as it requires all the conventional and takaful insurer to seek their licenses and new style of lifestyle, and all general insurance business must be under separate units. In consequence with the restructuring, the IFSA expressed the existence of the fund that maintains all contribution donated by the participants, which the Takaful Act failed to create. Moreover, IFSA has included the beneficiaries of the Takaful participants as the participants of the Takaful benefits, which was not included in the Takaful Act. Moreover, IFSA also has given the Bank Negara Malaysia and the SSC powers in cases of non-compliance by the companies and on the issue of takaful and retakaful operators, which explains they can charge a higher price in comparison of the conventional counterparts. Last but not least, IFSA also provides a comprehensive legal framework which is consistent with Sharia. Considering everything, the conversion towards IFSA might achieve the objective to maintain the current lines of business whilst facilitating the expansion into new line of business with the longer term, which means this change will provide greater growth opportunities and contribute positively to the prospect of both companies through greater synergy and effective execution of the across-the-board strategies to lead the takaful industry management.
For the conclusion, we can conclude that takaful is an Islamic Sharia compliant insurance and is projected to expand to a number of additional Islamic and non-Islamic countries in the future. Takaful is well evolved in some countries such as Malaysia and Saudi Arabia, in which there is a need for promotion, encouragement and development to ensure it is widely recognized and accessible to a large number of Muslim clients who require takaful with limit access. The findings from the country's research show disparities in the takaful industry growth phase. Malaysia has made significant strides by establishing a takaful regulatory and legal framework, Sharia compliant administration and effective corporate practice. Islamic Financial Service Act 2013 implementation has an effect on Malaysia's Islamic banking industry, specifically on its operating business practice. All operations must adhere to Sharia Advisory Council, Sharia Committee rulings made by Bank Negara Malaysia and Islamic financial institutions. Islamic Financial Service Act 2013 can help to stabilize the financial and Sharia compliance as well as to significantly improve Islamic financial institution administration. Thus, for the growth and development of Malaysia's Islamic banking and finance industry, the implementation of Islamic Financial Service Act 2013 is necessary to improve compliance with Sharia. That's all from us. Thank you.